Looks like we're about just a minute away from being able to start today's webinar. So let me just make sure everything is working here. Looks like we've got our PowerPoint presentation showing up. Hopefully sound quality is going through and working, so that works. Which it looks like it is. Awesome. Hey, it's just about 1 o'clock Eastern time zone. Welcome everywhere. Welcome everyone out there on the introverts out there looking at business credit and joining us today to learn more about topics and ideas that have to revolve around credit. Uh, Welcome to today's webinar. Today is dealing with how to avoid expensive surprises that banks hide in their credit card terms. I know these are often brought to you by Ty. He's actually out of the office here this week, so he asked me to attend and to join in to present this valuable information. My name is Lane McGleston. I've done a few of these here in the past and grateful to be working for Credit Suite and grateful to be working for Ty. We've been working together for 10 plus years, quite a while here. So once again, thanks so much for joining in. For those who are new to our webinars, feel free to check out our information at creditsuite.com. And at the bottom of the webinar on this particular one, there's a link here that goes to creditsuite.com/live or live. And that you can get some additional information specific about these topics or information that we share. So once again, thanks so much for joining us here today. I believe Keith is also attending. He's our marketing director and he is well, he actually might be doing another webinar right now. But awesome. Let's get started here with how to avoid expensive surprises that banks hide in their credit card terms. Uh, here's, well, let me actually make sure that that's working on here. Boom. There we go. When you're, I consider myself, I guess, a little older, so making sure I always have the technology working and jumping back and forth between them and having the right slides functioning, I always want to make sure I have that correct. But here it is. Ty Crandall is our CEO. If you are interested in funding, down at the bottom, there is the creditsuite.com get funding link as well. Previously, from a prior webinar, which if you're watching this as a recorded webinar back on our YouTube station, may or may not be kind of right around, but we were talking about the 3 business credit bureaus. We were getting kind of the information on how they kind of trick or are harder to understand and what makes each one unique within these 3 business credit bureaus. That's with Dun & Bradstreet, Corporate Experian, and Corporate Equifax, and why they matter to your business. Today, we're going to be talking specifically about credit card. And we're going to be talking about what credit cards, how it provides funding. We're going to be jumping back and forth between personal credit cards and business credit cards and kind of looking at an in-depth look at what credit card terms are and also looking at the processes of how to get them initially approved and also the laws that have been established to protect you as a consumer when it comes to credit cards overall. Now, a credit card is a funding process or a type. So if you're new to the credit industry or trying to get funding for personal reasons or for business reason, one of the options or vehicles that are out there are specifically with credit cards. So when you sign up for a credit card, this is whether it's business or personal, your signature on that credit card agreement signifies that you're accepting the terms that are in that agreement. Now, what do you mean by those terms anyways? This is what has been set up by the credit card company or the lender in an agreement on how or what they'll be paid based on the use of the debt that you're incurring from that credit card. So going back a few years before 2009, the law was less um, concise when it comes to credit card companies. And then the credit card companies came into some flack from the government and from consumers of having very nebulous processes and terms and changing things. So they actually did an update and saying, hey, we need to do a Consumer Protection Act and law to be able to protect the consumer, especially when it comes to credit cards. So if you had credit cards before this time frame, you might have noticed that nowadays credit cards are more concise and easier to understand, but there's still some ambiguity that's in there that's important to understand before you do those agreements. So both federal and state laws can apply to these credit card transactions. So in 2009, the Congress passed the Credit Card Act, which is more nominally as the Credit Card Bill of Rights. They wanted to make sure that the consumers are being protected before agreeing to different terms of the credit cards, and they wanted to make sure that the credit card companies were playing by fairer terms and not taking advantages of their clients. So one of the things that the act did was to allow for the creation of the Consumer Financial Protection Bureau. This protection bureau does hand out fines to card users if they violate in the law. However, this also Protection Bureau does not hand out business credit cards. So within that law, the law also requires that consumer credit cards issued to be plain language when communicating to the consumer. But the card law does not apply to the business credit cards. So similar to the federal or the personal trade act where the consumer is protected overall. The laws that might fall within personal credit cards don't necessarily transfer over into the business world. But as a result, business credit card agreements can be long and dense with a lot of legalese. Now, we have noticed that a lot of even business credit cards have kind of fallen in where they're trying to make things easier to understand and be in plain language just for the benefit of the consumer overall. So within this business credit card terms, you will have some important aspects that you want to be aware of before you really sign on the dotted line. So we want to go over a lot of these terms and what they actually mean so that you have better knowledge of what you're getting into. And this way you can also potentially save based on what are the terms of the agreements now and later on, and make informed decisions about your payments, the perks that are involved, and the terms that are involved in these credit cards. So the cardholder agreement, before you get a credit card established, there's an actual credit card agreement that you want to go over. It's something that you don't want to just browse through, kind of like if you get a new account with Facebook and it says, hey, here's the terms and agreements, and it's 100 pages long, and you just click, oh, agree and move on. This is something you actually want to really look through to be able to see what the credit card agreement's holding. So we're going to look through these agreements so you have a better idea of what to look for. Also provided in the terms and conditions of the credit card agreement, and it also has a binding agreement between the card issuer and its customers. So this is a contract in a way that you are entering in between the credit card company, which is the lender, and then you as the credit card holder. Now, changes in the cardholder agreement can be made or written advance notice by the issuer. So you have to be aware that they do kind of control that. And it must include an annual percentage rate. It must include information about the monthly minimum per payment amount or their formula. And it also needs to make sure and disclose if there's any annual fees and how the disputing resolution process takes place. These were all specific items that needed to be included in the Credit Card Act to make sure that the consumer is aware of what they're agreeing to. First of all, one of the first wings, and this is often the most common question asked regarding on a credit card, is interest rates. For those who are new to the lending process or even obtaining a credit card, an interest rate is simply the price a lender is going to charge for loaning out money. But with credit cards, lenders can actually set multiple interest rates. So it can add some complexity to it because you might not be aware exactly which APR or interest rates currently happening or what you're agreeing to. So you want to make sure you're aware in the terms and conditions on if it's adjusting or if it has an adjustable rate that's included in it. So an example is you may have a lower teaser kind of introductory rate when you first open up an account, but and then it's followed by a higher standard rate for your purchases, which turns out into a more of a penalty rate if you happen to be late overall. So a lot of credit card companies will try to entice individuals to get these accounts by having a 6-month to a 12-month, even as some, not as many nowadays, but in the past we've even seen 18 months 0% introductory rate, meaning that you would be paying 0% interest on purchases during that certain time frame, and then it switches to a different rate. As a result, you may have owing balances to a credit card companies based on these different rates. So it is something to be aware of to find out what that time frame is if it is an introductory kind of teaser lower interest rate amount. Interest rates on credit cards are expressed in a standardized way so that you can more easily compare with other companies. This is one of the things that they talked about in plain language, helping the consumer have a better understanding of knowing what they can compare. In the past, it was based on the credit card company. So you would be comparing apples with oranges, and they wanted to just say, hey, we're going to standardize it so everyone knows that you're comparing oranges with oranges so that they have very similar ways to compare it. That standard way is known as the APR, which is your annual percentage rate. With credit cards, the interest rate is calculated based on your average daily balances times that rate. So the credit card interest rates are expressed in the standardized way as the APR, just as it was mentioned. So that APR is a yearly interest rate that includes fees and costs paid on borrowed money that's loaned out or credit to you. Lenders are required by law to disclose what this actual amount is, that APR or that annual percentage rate. The rate is calculated by taking the periodic rate, multiplying it by the number of billing periods during that year. So the credit card companies might have a separate APR listed for balance transfers in comparison to cash advances or other specific offers that are on here. So oftentimes what happens is when people are comparing these different credit cards, the APR might be marketed or disclosed to have a certain amount. Now, that disclosure on a certain amount initially on marketing might be different after you get the forms because you want to confirm to see if it is that introductory rate or if it is one of these specific other offers that are included on the credit card companies. So if the offers are subject to an expiration date, the relevant balance will usually revert to your default APR rate on that credit card. So some might be asking, what is a default APR? But that is not only the purpose of a default APR. If you're late in making a payment, your standard APR may include this default APR rate, and it might be applied to all outstanding balances that happen on your credit card as well. Normally, if you're more than 60 days late on paying that monthly bill is what it happens. I believe a little later on here explains that one of the other changes that happened in the past, and I believe this is still pretty consistent, is there was a certain date on when credit card companies would report late payments. If there was a late payment, in most cases, we see that there was an extended grace period that if say your today would be the 10th of the month and you were late on the 10th, in the past they could report you immediately late basically that day or on the 11th if they didn't receive payment. We have seen that credit card companies or even mortgage companies will have a time frame that they've given you to make payment before they report a negative account back onto your account, which is different than business. That leeway isn't really there on a business account. when you're immediately late, it can immediately be reported as late. So the difference between a fixed rate or a fixed APR, or what this more specifically means in comparison to an adjustable rate, is this annual percentage rate that does not change throughout the year. Based on what you would receive, that rate is consistent during that timeline, and is unlikely that the introductory APR rate changes after a specific amount of time. Again, normally 6 months to 12 months is where that introductory rate will take place. But the fixed APR will likely change if there is a prime rate changes. So it does make sense to pay attention to financial news so you know if the prime rate changes or if your credit card company has that written in so that they can change that annual rate for your credit card. Now, one of the aspects of your credit card is it has something called a credit limit. To get into more detail on specifically what this credit limit is, let's take a look at it. Your credit limit is the maximum amount that you're allowed to borrow specifically on that card. It's the size of your credit limit and how much has been used, and it can influence your credit scores. Now, if you've dived in more deeper when it comes to credit cards or personal credit or trying to improve your personal credit, one of the factors, and there's actually it's like 5 or 6 different factors that fall into the formula of determining what your credit score could be. So it could be basically like number of inquiries. It could be your utilization. It could be length and time in history. It can be new accounts or negative information. So if you have information like collections, it can all affect your personal credit scores. One aspect is your credit limit and your utilization. That simply means is calculating at what percentage is your credit limit currently being used. So for an easy example, let's say you had a credit card and it had a 10,000 limit amount. Now, if you used 5,000, which is exactly half, they would consider that 50%. It would be at 50% utilization is currently used on the account. Now, when it comes to personal credit cards or personal credit in the formula, they're often looking at that utilization and they prefer that your limit amounts are below 50%. Even closer to 30% would be more ideal. If it gets higher, like 80 or 90 or even up to 100%, basically a lender is going to be worried or concerned. So a credit limit is important to look at because that can help determine where your score is. On business credit, it's different. On business credit, that utilization doesn't affect your score in the same way that personal credit. So if you exceed that credit limit on your card, so say again that example, you had a $10,000 limit, and say for an example you happen to go to 11,000, then there could be a penalty, a fee that's charged. And that should be in your terms and agreement, determining if there is a flexible amount that allows you to go over that limit amount. It might be something you have to physically call in and ask for, like on a temporary basis, to increase your limit amount on certain purchases. But be aware that there's often a fee that is attributed to going over your credit limit amount. So on your balances, we're going to just look over on how that affects. So on a credit card account or on a credit line, the balance is the amount owed. So when a card holder does not pay the monthly owed amount in full, then there's a balance that's carried over from month to month. And that's simply where you're also being charged to have the privilege of being able to borrow that money. In some cases, you might need to hold on to that balance. You might not have the cash flow necessary to take care of it, but you might need a month. So it's simply having that privilege or ability to hold that balance allowed you with the credit card. Now that's where the APR comes in on what you're being charged on that balance from month to month overall. So I have noticed talking to individuals who are brand new in the credit industry and they're trying to build credit and trying to get established, even talking this over with my now credit card companies, any interest. What it means simply is you have to pay off your credit cards every single month. And if you do that, you shouldn't have to pay them any interest at all. Because part of the agreement is you're borrowing money on a short-term basis, and as long as you pay it back within that allotted amount of time, the credit card company shouldn't charge you anything. If you hold that balance on, that's where the charge comes. So the credit card companies are hoping in a way that you will hold a balance from month to month because that's how they generate revenue. But you can use their system to take advantage of their system to be able to use their account in a way to make purchases without using your immediate cash, but you just have to make sure you pay it off within that allotted time so you're not paying any interest on those balances. So a balance transfer, one of the benefits of a credit card that they'll indicate in these terms is the ability to transfer debt from one account to another. That's what a balance transfer means. Now, this is a nice benefit, especially say for an example, you had a credit card that's older and you get a brand new credit card that has a low introductory rate, or it has a lower rate, or it has a 0%. The concern is, even though your credit card might have a 0% introductory APR, if you want to transfer from one to another, that's a different category. So you have to make sure you're specifically looking at the terms to find out what is the charge for moving a balance transfer from one account to another. It doesn't necessarily mean that you can just move from one account to your next account and automatically get that 0%. You want to make sure in the terms you see what charge it's going to be. So a balance transfer occurs when an outstanding balance on one credit card or several, in particular some other cases, is moved to a different credit card. But this is often done when looking for a lower interest rate. And many credit card users are offered that introductory balance that are lower than the standard rate, but balance transfer fees usually can occur. So you have to be careful. A balance transfer fee is a fee charged by the credit card company simply to transfer the balance from one account to another. And this fee often is a lower percentage, maybe 3 to 5% of what the transfer amount is, just to kind of give you an idea. However, if that balance is currently under a high percentage, let's say 20%, and then you can pay this smaller fee to move it into a 0%, overall, you'll be paying less interest to the banks. So more importantly, is you're just doing a little mathematics to determine, what's the better, which scenario will be able to provide you the least amount of interest that you have to pay. Now, not to get confused with credit cards, we're going to take a little jump over here to what a charge card is. This is different than a credit card. Oftentimes, this can also be referred to as simply a store card or a vendor card. So yeah, let's go through it, then we'll talk it through. However, not all business credit cards are allowed leaving balances on the card. A charge card is a payment card that requires payment in full with each billing cycle when the statement is due. Another way we've heard of this before is they'll call net term accounts. So you can set up accounts with different companies, with different stores, and be able to have a net term account. The net term is usually indicated by a number, and that number represents how many days you have to pay it off. So most commonly, you'll hear of a net 15, some as low as even a net 10, net 10, net 15. The most common that we see is net 30. Net 30 simply means that you have 30 days to pay off your bill in full from when that purchase takes place. Now, they don't offer the ability to have a balance to transfer one month to the month. It simply, they say, is based on this due date, the amount has to be paid in full. So unlike credit cards, which give the borrower the revolving line of credit that can excess be paid down over time, these charge cards do not allow these balances to be carried forward from one to another. And they do not charge an interest rate as well. So the other thing to be important is they do have penalties if you do not pay in full, but there isn't an APR that's required for a revolving account that allows you to hold these balances on here. Some might ask, what are the benefits of then having a charge card in comparison to having just a credit card? Is these often will report back on the credit bureaus. So these ones can actively be used to build credit history, which can provide greater approvals in the future or even better terms in the future. So it is a great way to create a track record and history, both for businesses as well as personal. So that's definitely something to be aware of. And it might give you better terms than necessarily a credit card based on your volume that you're having. Like one that comes to mind is if you had a commercial account specifically with Home Depot or with Lowe's, they might be able to give you better terms specifically for their purchases. If you're a contractor and you're making a lot of purchases and they can see that, they want to give you some extra benefits. So there will be benefits that they can give you in the form of a charge card, basically to incentivize you to use their store and their products. So you can just look at the terms and see what these benefits could be. Now, part of a credit card, one of the aspects that are on here in the terms and condition talk about is minimum payments. So credit cards are often charged a minimum amount that has to be charged. Now, again, don't get this confused with a charge account or a store account. This is going back to a revolving account. So these minimum payments would be the smallest amount that you must pay to keep your account from going into a default or a late payment status. And also, one of the aspects to help reduce your debt more quickly is it is possible that you can pay more than just the minimum payment that's required on that monthly basis. So at the same time, you're avoiding adding any new charges. Some clients that I've spoken to where they get into uh, maybe it's not no fault of their own or things have happened or they have extra expenses where all of a sudden they have these credit card debts and they've asked, how do you consolidate? How do you work through it? One of the things I find is an important aspect is creating a spreadsheet. You know, list all your credit cards that are out there, and then you want to list what is the APR, the interest rate, so you know what you're being charged, and you want to list what are all your minimum payment amounts that you have to pay. And usually what you can do is you can indicate, I think this is kind of even the Dave Ramsey thought process. He says you want to, find which one you're going to attack first. And you're going to look at that particular account and all your extra money, pay into it until you can have it all the way paid down to zero. And then you move that payment into your next one and keep focusing on it all the way down until you can have a better control of those credit cards and you're not, underwater because of the interest. But it's important to know what those minimum balances are because that can help you determine which card to focus on first. If you get into the situation where you aren't able to make that minimum monthly payment, then what happens is the credit card companies will have indicated in their terms and conditions what fee will attribute if that takes place. So a late payment fee or a late charge is charged by the borrower who misses paying at least their minimum payment or beyond that payment deadline. In order to avoid these fees, you need to make sure that you're making at least the minimum payment due by that due date. Late payments can affect your credit history negatively if your entire outstanding balance is later paid in full. Now, one important aspect, and actually, let me see. Okay, here, the consumer credit world, occasionally late fees are capped at 25 under the federal regulations. The other important aspect is that's specifically talking to the consumer credit world or personal credit cards, meaning that's a cap for personal credit cards. Business credit's different, they fall under different regulations. There's also often a grace period that can take place in comparison to business credit, so you want to be aware to understand the difference between those different credit cards. Now, if you do end up getting a delinquent account, the account is past due, the consumer credit card industry, the card issuer usually will not report an account as delinquent until at least 30 days has gone past due the due date. Here's that grace period that they give you within a consumer or personal credit card. And I believe the same thing happens within current mortgages. So even if you pay, like say today's the 10th, that on the 10th the payment is due, according to like even on a mortgage, is if you pay your mortgage and it's time stamped as being paid on that certain date and it's in the mail and it's still received in a time frame, that mortgage company shouldn't report it as late, similar to the credit cards. Business is different. If you're late on that date, it doesn't matter if it's in transit or if it's in the mail or any of that. They'll simply report it as late. So you want to make sure that you're making sure all your business accounts are being paid early you don't get into that aspect because many will just automatically report you as a delinquent account on the day that it's due if they don't receive payment. In a business, oh, here it is. In a business world, the account can go delinquent in day one. So you want to make sure you're clarifying the difference between personal credit cards and business credit card accounts. Back to an annual, or not back to, another fee that can happen while you're going through the process of credit cards is an annual fee. Not all credit cards have it. Some credit cards do. So you want to make sure that you're aware in the terms and conditions if there is an annual fee. A few years ago, I got a credit card company, and it comes to mind, I think it was with Chase. It was a corporate card. I got it, and after a year, all of a sudden I had it. I think it was like a $350 charge on my account. And I'm like, what in the world was this? I mean, I, it was totally my bad. I didn't go through and outline and see all the terms and conditions, and I literally missed that there was an annual fee that took place of having that corporate account. And it wasn't until I went back and looked through the terms and conditions where I realized, oh my goodness, there is an annual fee, and they specifically had written in that that annual fee was waived for new accounts, but took place after the first year. So I promptly called up and canceled it because I don't personally believe in the annual fees. It didn't outweigh the benefits that I was getting from that particular card. In some cases, it might. In some cases, an annual fee does outweigh the benefits of having it. I haven't seen it specifically in a credit card, but I have to admit, I'm a Costco member, and we pay an annual fee every month to be able to shop at Costco. So this is a fee that's charged by business credit card holders. And it might be endured by an annual fee. This is a yearly fee that banks charge for the privilege of using their credit card. So annual fees can run up to even around $500 per year. Ideally, the best way to use the card that doesn't impose an annual fee, but there are cards which have introductory offers with no annual fee, but always check in the fine print, just in the case that I gave you on mine, what the annual fee might be after the introductory period. So that totally was a surprise on my end that I wasn't aware of, is to confirm that for future credit card use. Another charge, especially if you're an international traveler, especially as a lot of countries are going to be starting opening up. I even heard that we're able to go back to Canada, our northern neighbors again here. But you have to be aware that when you're traveling and using your credit cards in a foreign location, that there can be a fee that's applied to your credit card based on that usage as well. So this fee may be known as a foreign transaction fee or just an exchange fee, being able to exchange basically the currency of your current home nation into a different currency on wherever you're currently at. So these fees are charged by many credit card companies on purchases made in foreign currencies or purchases involving a foreign bank, regardless of regardless if the foreign currency is being used. Usually these fees are a percentage of the amount for each foreign currency purchases with no minimum or maximum. Foreign transaction fees are charged by transaction processors like Visa and MasterCard, and these cards issuing banks may choose to pass that fee along to the consumer. So more issues have dropped foreign transaction fees, particularly from their travel cards. So when you have a card and it's giving you different benefits, which I think we're going to go into here in just a couple of slides, one of those benefits, if you have a travel card, is usually they'll indicate if there is a fee or not. One other important aspect, my family and I, wife, we don't travel often out of the country, but when we do, if we're going on a cruise, is to make sure you call your credit card companies beforehand to let them know which cards that you're going to be using, where you're going to be traveling to kind of give them a heads up. So that way they're aware that if you're going to be using that card, that it will be able to be processed okay, and you won't be stuck in a situation, maybe out to dinner, in Mexico or somewhere, and all of a sudden your credit card declines because your credit card thinks that it might be fraud. So be aware that's one of the things to look for, especially if you're traveling into foreign places. One of the main benefits, now we're going to kind of jump on what is besides the benefit of using other people's money on a short-term basis in a credit card, what are other benefits that come from credit cards? One of the number one benefits that credit card companies use nowadays is called cash back. And these are perks that are involved. So the credit card industries, what they do is they have reward programs that can return a percentage of the total amount spent on your credit card over a specific period of time. Going back to an example of like Costco. My wife and I, we have a Costco Visa card, and on that account, we still have to pay our annual fee, but based on the amount we purchase on a yearly basis that we receive cash back, it pays for that actual fee and we still get an additional check. So we look at that cash back benefit in a way of taking care of that annual fee. Um, if not, we might choose a different warehouse company. But this is often on a monthly basis, and surveys have shown that cashback is consistently the most popular form of perk or credit card rewards that are given back to consumers. This wasn't always the case in the past, these different type of rewards, but credit card companies are becoming more competitive to really keep their consumers happy, so in that way they can keep people using their cards. So it makes sense that cash isn't restricted in other ways that perks may be. There might be a sign-up bonus. A sign-up bonus is an enticement offered by card users to consumers for applying and using their particular card. So these sign-up bonuses have come pretty generously recently, especially when it comes to travel points and rewards. Um, Points usually will translate into a certain dollar amount based on your credit card company. So when you hear these different points, what's in your wallet, get these amount for travels, you can often look at these points, see what they translate into in the form of dollars and how they can be used for travel purposes. So often the cardholder will earn these bonuses by reaching a spending threshold in a limited initial period of time. For an example, in some initial points, you'll need to spend $3,000 on a card in the first 90 days to be able to get those initial benefits that are provided by the cards. I heard of a client recently where he got an American Express card, and the American Express card had that benefit, but he had to spend a minimum of, it was like 5,000 within that first 60-day time frame. And as long as he spent that amount in that time frame, then he would get an extra 10,000 bonus points on his travels that he would be able to use. So it is something that you can be aware of, but the most important thing I think is to do the research and to see if you're actually able to use these bonus incentives truly. Because if they're not able to be used, then it might be a benefit that really doesn't benefit you at all. And you might just look to an account that gives you just strict cash back. Loyalty programs. Another kind of perk involves being enrolled in a loyalty program. These programs are given to card holders as an incentives to use their specific cards. They also have their own card, reward card, points card, discount cards, or a membership card. So a good example of this one would be like Sam's Club or even Costco, where you can get specific revolving accounts or store accounts to be able to use for those specific perks. Even airlines have loyalty credit cards that can grant their discounts on flights, depending on a certain amount of goals of what they're using. Now, when it comes to getting credit cards overall, there's a lot of terms that are out there that are used that can be kind of confusing of understanding what a personal guarantor is, what an account holder is, um, what the debtor is, and to be able to have a better understand of how it affects your credit. So an account holder, and we're going to look at that, the credit card account holder is simply the person who is responsible for making sure the bill is paid. So that who is the card holder. Now, this person is allowed to use the credit card as an authorized user, but not legally liable in the debt. Wait a minute, make sure I had that here switch. Is a person responsible for paying the amount charged. Correct. A co-signer, I had to double check for a second there. I thought I might have said something that's odd, and maybe I did, but we'll go in depth on these other ones to make sure that it makes sense. But for some reason in my brain, I said didn't sound Correct. A co-signer is someone who is on the agreement also to pay off with someone else. So it's two people who are going in who are both going to be holders, and both of them are agreeing that they're going to be responsible for the bill. So this co-signer is a technique often used between family and friends to let a person with good credit vouch for someone on a new credit or bad credit to get a loan. Oftentimes you've heard of individuals doing a co-signing on a car loan. Say you have a son or a daughter who's 18 and they needed to get a car on their own. They don't have enough credit, so you can co-sign. So both of you are responsible for making sure that you pay your bills, which is different than an authorized user, which is coming up. So this can be helpful for new business owners with no business credit yet, or you can have a co-signer, which will lend more to approve loans for high-risk borrowers. Other information on the co-signer is, while a co-signer allows a person with bad credit to get the loan, it puts the person with good credit on the hook for the entire borrowed amount. So polling data have showed that in the consumer credit world, 4 out of 5 co-signers end up paying at least part of the debt. So if you are being presented to be the co-signer, or if you're looking for a co-signer, you want to make sure that they're fully aware that, yes, they are promising to pay the debt on that account. A guarantor is a credit card account where a person who signs an agreement to pay off a loan or someone else if someone else defaults. It's similar to a co-signer in that the technique often is used between family and friends to let a person with good credit vouch for a person with new credit or bad credit to get a loan. Similar to the co-signer, the guarantor is also co-signing to make lender more willing to approve for their high risk, and they are also on the hook for the entire amount that's borrowed. So you want to make sure that they're also being treated differently in collection process when a loan defaults. The bank first must exhaust other means on a collections before turning to the guarantor. Now, an authorized user is another player in the game of credit cards or loans that are out there. Now, with an authorized user, this is different. An authorized user is anyone who has basically been given permission to be able to use that credit card. So this person is also not responsible for paying the bill. So say, for an example, that you had a credit card and you got your own credit card, and then you wanted your spouse to be able to be on that credit card. You didn't go in together, you both didn't apply, but you just wanted to give that benefit to your spouse to be able to be on that account as well. What you can do as the guarantor, call up the credit card company and say, I would like to add on an authorized user onto this account. They're basically understanding and saying that since you're the responsible party, you're still promising to pay the bill regardless what happens to the authorized user. They'll give that permission to the authorized user, and you can even get an account with their name on that card, even though they're not promising to pay that off in full. They're not legally responsible to it, but that's what an authorized user is. In the past, and this just goes into a little depth of how it affects your credit score. If you're an authorized user and you're showing up on an account, that often will affect your personal credit score, and usually it's for your benefit. The concern comes is if you're trying to apply for credit, they'll recognize that you're only an authorized user, and they'll usually scrub that data in making their determination if you can get approved or not for a credit card yourself. So you might have a fantastic credit score. You might have 10 authorized user accounts and have an 800, and you might think my credit is phenomenal. If you went in front of a lender, what they'll do is they'll look down those accounts and they'll simply say, oh, none of these accounts are primary. We're going to remove them and make our determination based on what you've guarantored yourself. So that can affect if you're looking for credit here in the future. Now that we went on a tangent, we'll jump back on here to the slides. So an authorized user differs from a joint credit where both parties are obliged to pay. In some cases, the users will receive a credit card in their own name, even though it is linked to someone else's account. So joint credit or a joint account, that's where credit cards is equally shared by 2 or more individuals. I know some of you might be saying out there, wait a minute, isn't that the same as like a cosigner? And yes, it's very similar to it. These parties are involved to share associated rights and liabilities of the credit accounts are regarded by law by co-owners or the account. This means that if anything happens, such defaults or frauds or both, all parties are affected. Being a joint credit card holder is different from being an authorized user. An authorized user has permission to make changes to a card, but is not responsible for the payment. So I would categorize that very similar to the co-signer or dual guarantors as also a joint account. Basically, all responsible parties are all responsible on the account, and it can affect all their credit. One of the aspects that come into play when it comes to getting approval is a credit inquiry. A credit inquiry, and that's one of the points of personal credit that will determine your personal credit scores. It's one of the factors, part of their formula, as they look at your inquiries. It simply means is how often are you looking for credit? Every time you put in an application or you look for credit and you're trying to get approved, there's an inquiry that can take place. And if that's happening quite often, the lender simply think they're worried or there's a concern. Say that they have an applicant who has one inquiry in the last 6 months, in comparison to an applicant who has 100 inquiries in the last 6 months. A bank lender will look at that and they'll say, well, the person who's only looking for one is less risky because it doesn't look like they're in trouble. It looks like they're managing their accounts well, and it looks like that they're being more responsible for the debt or credit that they've already been given, in comparison to the other applicant who might have 100 inquiries in the last 6 months. They might look at that candidate and simply say, oh, this person looks risky. Something's happening in their life where they're asking everyone for credit. So they might look into their application a little bit more concerning because of it. So a credit inquiry is when a lender simply pulls someone's credit report and it creates an account on the report. So each time that borrower, lender, or potential lender gets a copy of a credit report, it pulls this inquiry. And they're concerned, especially over multiple inquiries, can negatively affect your credit score. There's two kind of inquiries that really can take place. There's a hard inquiry and a soft inquiry. Um, and if you've been in the industry a while, you might be aware of them, but we'll go through each. A hard inquiry is the initial step by a lender to evaluate a loan application. So the potential lender, the bank, what they'll do is they'll check your credit report. It does leave a small negative impact on that credit score. And occasionally the hard inquiry also has a small impact on that credit score. And it can stay on your account for 2 years. What hurts a credit score most are multiple hard inquiries over a longer period of time, where it changes your credit score algorithm and it's treated as suspicious, as mentioned. Since we could signal hard inquiries be following the borrow well, also known as a hard pull. A soft inquiry is different. A soft inquiry is when a credit report is checked that does not impact your credit borrower's credit score. It's also known as a soft pull. Soft inquiry, as a rule, comes from evaluations that don't result in granting of credit. So for an example, a consumer, you personally right now have the rights by law to pull your credit report as many times as you would like. Most of the credit bureaus will provide you one free report per year that you can request directly through the credit bureaus. But there's a lot of services that are out there that you can actually create a monthly subscription where you can watch and look at your personal credit basis on a daily basis. There's nothing against that. And the law provides you that ability to do it. But every time you pull your report, it's not causing an inquiry because it's yours personally, so it's not affecting your score. Other examples include periodic checks by existing creditors or credit information pulled by insurance company on the course of deciding whether to offer insurance. Another aspect comes in depending on what type of jobs that are out there. If you're being issued to a government job, oftentimes they'll do like an FBI background check to be able to check your credit as well, which is different in the aspect in a hard inquiry where it's issuing you credit, since they're just doing a check on you personally. Some get these confused compared to a personal guarantor check for credit in comparison to a soft pull just to determine as for a quote. A good example is we have a funding program in our, I guess, database for a credit card hybrid program where business owners can apply for business credit cards based on their good personal credit. The initial quote is done by a soft pull, which allows the lenders to be able to do a soft pull and come back with a quote to be able to say to that business owner, based on our estimates, this is what we assume that you can get approved for from what we see. Now, then the business owner at that point has the ability to decide and say, well, hey, that's a good quote. I want to move forward with that funding program. At that point, that's when actual applications are being submitted and the hard pull takes place because they're officially applying for credit. But initially, they do the soft pull first just so that they know what their estimate is on what they expect they can get approved for, and then they decide to move forward at that point. But again, creditsuite.com/get funding is a great way to be able to look at that to see if that's something that can help out through your business. I think we have a few more slides here because we're almost running on that hour time frame. The dispute process. So in the dispute process, part of that law that changed allows clients to be able, or consumer credit cards, the ability to be able to dispute if there is unauthorized or negative information that's occurring. So if you notice that there are unauthorized transactions or a disagreement with a charge on your statement, you can dispute this with your card issuer. In the consumer credit world, the issuer typically has 2 billing cycles to resolve that dispute. In the meantime, you may receive temporary credit for that dispute amount if you're going through that dispute process. Credit issuers will want to see some form of proof backing up any disputes. There are companies that are out there who specifically in a way are experts on the process of personal credit repair and knowing the law. They're kind of like your advocate when it comes to fixing negative personal credit. We don't directly do that here at Credit Suite, but I know there's great companies out there who do. So if you're in that position and you're looking for help, yeah, do a little search, be able to find these companies and they can help out through. Now, just as a quick recap, looking over, today we spoke about specifically credit cards, what credit cards are, how credit cards are obtained, a lot of the perks that are involved in credit cards as well. But back to the title overall, wanting to make sure that hopefully you learned something new today on some of the fees that might take place in credit cards that you might not have been aware of here beforehand. So one of the most important things is whenever you're applying for a credit card, definitely look over the terms and conditions and definitely look over their fee structure to be able to have a better idea specifically of what that APR is, introductory rate, seeing if there's any annual fees, because that's probably the most common surprised aspect if there is an annual fee, looking to see if there's extra fees if you need to use with balance transfers or cash advances. Those have different fees that are involved. Or if you're a international traveler, to make sure you confirm to see what the extra fee might be for international traveling. One of the important aspects is in 2009 is that for the consumer, laws were passed to be able to help benefit to better understand the plain language. So it's not all in just that legalese that we can look at the terms and we can understand. And they also changed it so that it's more uniform across the board. So in that way, they're explaining their fees uniformly, orange to orange to orange to orange, rather than to apple to banana to grapes and all over the place, which definitely helps us as a consumer. Interest rates are in details based on the APR. Most important is to look at the introductory or if it's the fixed rate, and people who can use credit cards are defined and their roles and their responsibilities. That goes back to the quick recap. Basically, if you're a guarantor or a joint guarantor or a co-signer in comparison to an authorized user who isn't responsible for paying the bill and it's not their credit that's going to be hit. So you always want to make sure, are you the responsible party and how will it affect your credit scores, such as the co-signers and that. If you are looking for more information regarding the services that are provided here at Credit Suite, actually, this is a new slide that it looks like they put on here. It looks like the next streamline that we'll be covering, and if this is a playback, feel free to look up this information here on our YouTube account. We're going to be talking about cashback credit cards, how perks difference, and how amount outweigh percentages of cash that you get back. Oh, awesome. So stay tuned for that next information. Again, if you're looking for funding for your credit, feel free to check out our information here at creditsuite.com. If you go to business loan link up at the top of our website, it will give you some additional information, even a link to open up a conversation with our funding team overall. Sure do appreciate those who have attended. Hope you've enjoyed this information and be able to learn something new regarding all the different fees that attribute to your credit card companies that are out there to hopefully prevent those surprising, like in the case for me in that Chase account. Yeah, that annual fee was a surprise after it came through. Thank you again for joining us. Hope you all have a wonderful day and see you on the next time. Have a great day.